The headline of today's video is The Clash of Metals: Why Copper is Killing Gold in 2026. Now, before we dive into the data, a critical warning. This analysis is being produced at midday on Tuesday, February the 3rd. We are scheduled to release this at 7 p.m. GMT tonight. As we have seen over the last 48 hours, the volatility in the metals market is extreme. Since I started preparing this morning, the markets have already shifted. Silver is attempting to hold its bounce around $87, while gold is battling at $4,930. If you're watching this at 7 p.m. or later and the markets have shifted again, do not panic. The 98% react to the 1-minute candle. The 2% club reacts to the structural plumbing of the system. So what is the real story today? Is it the relief rally in silver? Or is it the silent, relentless bid under copper that most investors are completely ignoring? Well, welcome to Money and Power. If you're looking for objective, common sense commentary in a world of clickbait and panic, I invite you to subscribe to this channel and join our community. We don't chase candles, we analyze the hands that light them. Let's look at the scoreboard, because the trajectory over the last 12 months tells a story of two very different metals. Over the last year, gold has been the headline's darling. It has climbed nearly 74%, shattering every psychological barrier from $3,000 to $5,000. It has done its job as the shield. But look at copper. Over the same 12 months, copper is up roughly 39%. To the 98%, this looks like gold is the winner. But the 2% look at the 3-month momentum. In the last 90 days, gold has entered a consolidation phase, struggling with the higher for longer interest rate narrative brought on by the nomination of Kevin Warsh to the Fed. Meanwhile, copper has just successfully defended its floor at $6 per pound. Why does this matter? Because we're entering a phase where safe havens are being challenged by strategic assets. Gold protects you from what might happen. Copper is required for what is happening. The 12-month performance of gold was about fear. The next 12 months of copper performance will be about necessity. One of the biggest misconceptions the general public has is that we can just dig more when prices go up. This is where the 98% get it wrong every single time. If you wanted to open a new gold mine today, the global average from discovery to the first pour, that's P-O-U-R, is about 20 years. That's a long time. But copper is one of the slowest and most difficult metals to bring to market. According to S&P Global, the average lead time for a new copper mine is now 24 to 31 years. Think about that. The copper we need for the data centers being built today should have been permitted and dug in the year 2002. We are currently dealing with old world supply meeting new world demand. We've seen massive disruptions at the Grasberg mine in Indonesia and declining ore grades in Chile. We aren't just running out of copper, we're running out of time. While gold is sitting in vaults, the available above-ground copper stock is being eradicated. LME inventories are hovering near historic lows, often representing just a few weeks of global consumption. Now let's talk about the gorilla in the room, AI. I've done the research, so you don't have to. Everyone talks about the chips, Nvidia, Microsoft, Google, but you cannot have compute without copper. A single large-scale AI data center, the kind being planned in Data Center Alley in Northern Virginia, requires roughly 65,000 to 70,000 tons of copper for its internal systems and the surrounding grid infrastructure. JP Morgan and Morgan Stanley are both projecting that data center demand for copper will jump from 110,000 tons last year to nearly 500,000 tons in 2026. That is an explosive 400% increase in a single sector. And remember, Data center developers like Amazon or Google don't care if copper's $6 or $12. Copper represents less than 1% of their total project cost. They will pay any price to secure the metal, so they don't lose the AI race. They will outbid you, they will outbid the industrial manufacturers, and they will leave the 98% wondering why their electronic prices are skyrocketing. Now this brings us to the clash. Gold is currently being held back by a strong US dollar and the Warsh shock. When the Fed signals a hawkish turn, the opportunity cost of holding gold goes up because gold pays no dividend. But copper does have a yield. It's called industrial utility. In a world where Kevin Warsh represents financial gravity, gold may struggle to break $5,500 in the short term, but copper is being driven by a structural deficit that no interest rate hike can fix. You can raise rates to 10%, but Microsoft still needs copper for its power cables. The red gold is decoupling from the yellow gold. We are seeing a rotation where institutional capital, the sovereign wealth funds we will discuss in a future video, are moving away from passive safety, gold, and into active strategic assets, copper. Now, without being predictive, because the 2% club deals in probabilities, not certainties, where is the trajectory taking us? If you listen to the big investment banks, the Citis and Goldman Sachs of the world, many of them were forecasting copper to hit $12,500 by the end of 2026. As I record this at midday on February the 3rd, copper is already trading north of $13,300 per metric ton. The experts were too conservative. They underestimated the sheer velocity of the AI infrastructure build-out and the structural supply deficit. When the ceiling predicted for the end of the year becomes the floor in early February, you are no longer in a normal market. You are, in fact, in a structural breakout. So how easy is it to fix this? It isn't. To the 98%, a high price means people will just dig more. But in the real world of the 2% club, we know that current supplies are being eradicated. Recycling, what we call urban mining, cannot keep up. Even if we doubled recycling tomorrow, we would still be millions of tons short. We are moving toward a copper standard, where the price isn't set by traders in London, but by the necessity of the global power grid. So, what is the action plan for the 2% club? Yesterday, you saw the 98% panic sell their silver as it cracked the $80 floor. This morning, you see them panic buying the bounce back to $87. They are exhausted, emotional, and chasing shadows. We do things differently. We recognize that gold is our shield. It protects us from the systemic Warsh shock and the failure of the paper promise. We recognize that copper is our engine. It is the physical bottleneck of the AI era that will be repriced regardless of what the Fed does. And silver remains the wild card. The 2% don't panic sell silver because we know the math. With a 900 million ounce accumulated deficit and a gold to silver ratio still correcting from historic extremes, silver is the coiled spring. But you cannot build a house on a spring alone. You need the foundation of gold and the structural beams of copper. So if you are only holding gold, you are playing defense. If you are only holding silver, you are gambling on volatility. But if you are holding the triple threat, the shield, the engine, and the wild card, you are positioned for whatever 2026 throws at us. The headlines tonight will be about the silver recovery. They will tell you the danger has passed. The 2% know better. The Warsh shock was just the opening bell of a much larger systemic reset. If you want to understand the exact mechanics of why silver cracked yesterday before this bounce, you must watch my deep dive. the $5 trillion reset. And if you missed the technical data on why I'm rotating into industrial metals, go back and watch the 2% are buying the red gold. These two videos provide the essential foundation for everything we discussed today, and both should be appearing on your screen any second now. If you value this kind of objective, data-led commentary, please subscribe and hit the notification bell. And as always, I ask you to share this video. My channel grows because you share these links via WhatsApp and SMS to your own 2% club. That dark social growth is how we stay independent of the hype. Watch the New York Open closely today. The volatility isn't over, it's just changing shape. I'm Richard, this is Money and Power. Stay calm, stay grounded, and I'll see you in the next one.